Welcome back, guys. Today we will talk about the static analysis of open interest. As we saw in the previous video, this chart shows the interest of operators on each strike, both for puts and calls. We immediately note that the strikes furthest from the left side price, the downside, are mainly characterized by open interest of puts, with few open interest of call. Conversely, for the strikes furthest from the price on the right side, the upside, the presence of calls is predominant. There are several methods of observations, but almost all of these methods share the same approach. The seller has an interest in retaining the premium received from the option contract, and he will do everything to protect his money as long as it is convenient. So the first method is consider the open interest of put and call as interests of separate positions, as in the histogram. For example, if the price today is at 3,000, the seller who has previously sold the 2,800 strike put will agree to defend his position until it is profitable. 2,800 is therefore a level of interest, especially for the seller, because he has the real risk for his portfolio right there. The higher the put histogram, the more operators will do their best to avoid the price fall below the strike price. Some of them will be also interested in making the price of the underlying skyrocket well higher than 2,800. This is the origin of what technical analysis calls support, a level that someone has an interest in. And the interest is defend this level, otherwise he would incur a loss. And the more the sellers, the more important the support is. The same is true for calls. A large stack of calls at a strike means resistance. So, it happens that, if the market price drops, many put sellers have to protect their position, as the OTM and ATM puts that they sold approach the ITM. This implies they will incur a loss at expiration date. So they short the futures to protect the puts, and this will increase the open interest of the future. Obviously, in case they sold the calls, the option sellers will buy long futures to protect their positions. This also will increase the open interest of the future. Okay. So, let's move on and see another way to view the open interest as a function of support and resistance levels. We can export the chain in Excel and sort the open interests in descending order. Then we can identify the 2 or 3 main supports. Do the same with the calls, and we identify the 2 or 3 main resistances. Okay. Now we check where the price of the underlying is, and we act accordingly. We would give each support or resistance the importance it has, not by looking the price chart, but by the number of open contracts that are still in the market. Yet there's another way of considering open interest, and it is to add puts and calls together. This simply allows us to view the total interest and the total money per each strike. Finally, another way is to consider the net positions. We can subtract the open interest of the puts from the open interest of the calls. This is very intuitive. If a put becomes ITM, the corresponding call becomes OTM, and therefore expires without value. This measure actually gives the net exposure of the sellers. The net exposure gives us another picture of the market. Think about it. At expiration date, for each strike below the settlement price, there will be a loss on the open interest of the puts and a profit on the open interest of the calls. The sellers have to pay the intrinsic value of the ITM puts, but they keep the premium of the OTM calls because they expired with zero value. For each strike above the market price, of course, there is a loss for the sellers of the ITM calls and a profit on expired OTM puts, worthless. So, this net exposure shows the overall strategy of the market, which in this case is similar to a bullish future. It is also possible to calculate the optimal settlement point for all the sellers in the market, which is called minimum pain. That is the minimum point of loss, a price that will ideally be suitable for all sellers at expiration date. The analysis we have seen is a snapshot of the market situation at a given date. We observe it, we study its details, we perceive all the nuances, resistances and supports of the market, but even though it is beautiful, we draw a static idea from it. It gives us an interesting and effectively objective view of the market. However, this picture must be seen along with the movement and evolution of money over time. Thanks for your attention, see you in the next video.